Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have David Skarica, investor, speculator, and author of a new book, Mega Returns. Today you're going to learn how to profit when everyone else is terrified. As Warren Buffett has said, be greedy when others are fearful. That moment is rapidly approaching. We will discuss financial bubbles, debt cycles, and how to make money from the coming crash. David, thank you for coming back on the show.
Yeah, thanks for having me.
Yes. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Well, I do think that we potentially have started a bear market in equities now. Now, we got very oversold in the short term. The VIX 660, the sentiment was terrible. Obviously, we had all this bad news regarding tariffs and the whatnot. So definitely a rally was due, but like if you go look at I'm not talking about 2020 or 2018 or even 2020. I'm talking about the kind of the more major bear markets like 2000, 2002 or to 2002 or 2007, 2008, 9. If you go look at them, usually this starts with kind of a 15 to 20% correction in the S&P. And then you get a really nice kind of counter rally. And sometimes that rally can take you back to almost the highs. And then everything kind of rolls over. So I think we're in the midst of that counter rally right now, because I do think we're entering a recession. And again, if you go look at like the macro in terms of the valuations, which are still the most important things, and why I try not to let politics influence me, even I mean, obviously trade has a big influence on this, but in terms of a lot of people, late last year, early this year, thought the Republicans were going to have this big pro-growth, agenda, et cetera, and obviously that hasn't been the case in the first quarter and into April. And so what I think is basically we're seeing the big economic slowdown, and market cap to GDP hit 210%, which was an all-time high in February. Price to sales on the S&P hit over 3 times, which is an all-time high. So I think the valuations were like in the 99th percentile, and we needed a trigger for this decline to start, and the tariffs were the trigger. But it's really more to do with valuations, overvaluations. And I think the consumer and the economy is kind of tapped out.
Okay. So you see that you think we're entering into a bear market, although we've had a recent rally. You could see lower highs and lower lows coming into the future. And we're in a big overvaluation period right now. And yeah, basically everything's overvalued, and over as time goes on, you see the market going down.
Yeah, like I'm net long now. I have a couple beaten up plays, then that's kind of the basis of my book, buying cheap assets that I'm long. And I don't really have many shorts right now because, when that VIX hits, 60, that's pretty extreme, so that I think that was a pretty good washout that happens. But definitely, I think a counter trend rally can happen, over the next couple months, and then we'll just see how that plays out. Like I think 5,700 is a pretty key area on the S&P. If you can break that, maybe we go back to 6,000. But yeah, I don't see like a huge amount of upside from now until the fall. And I think one issue, and we talked about this just quickly, if you want to talk about macro. Yeah, let's go into the other markets, which I think were very worrisome during this sell-off. Is that usually 2 things happen during these sell-offs. There's a bid into U.S. bonds, as a safe haven, like the long bond that happened 2020, 2008, et cetera. And then there's a bid on the U.S. dollar. That didn't happen this time. And I think a lot of their rhetoric coming out of the White House was a reason for this, because foreign investors started pulling capital out and putting it into other safe havens. Gold rocketed, Swiss franc went up a lot, even the euro went up a lot. So I think that is a real turning point. And one thing I want to see the market's reaction, I think the bond market is more important, because with this huge $36 trillion debt, with the deficit on pace to be $2.6 trillion this year, I think it's more important that the bond market than the equity market. And I think these tax cuts are going to be unfunded. And if they're unfunded by spending cuts, that's what I mean by that. Something that's similar that happened to the Brits in 2022, when Liz Truss tried to do tax cuts without spending cuts. The pound tanked and interest rates blew out, and the central bank had to step in. That could happen with the Republican tax cut plan. If people see, hey, this $2.6 trillion deficit, which is already 9% of GDP, is going to be $3 trillion. And like you can't afford that. You might see those bond yields start to spike, and that could really cause something to, bad to happen. Now that is more for the summer and fall, just so you know. If that, now it's tough to predict these things exactly, but this is kind of what I'm thinking right now, because I think because of all this trade war stuff, foreigners are not going to be buying the US bonds like they used to.
Yeah, that's interesting what you say about the tax cuts, that they're unfunded. So basically, you're saying that they're going to cut spending, but they're not going to pay for it. and
Well, cut taxes. Yeah. Well, they're not
I'm
cutting,
sorry, cut taxes, yeah,
like,
but not pay for it.
I was hopeful that Musk could do something with Doge, but it's kind of been a bust. Like, yeah, he went from $2 trillion to 150, and I don't even know if he's going to get to 150. And then that 150 billion in cuts is going to be replaced by increases in spending elsewhere. So I've thought all along, and I've thought this for years. Like, one of the first books I read that got me interested in economics, talking about macro, was Bankruptcy 1995 by Harry Figge. And looks like he's 30 years off, but he talked about the issues with debts and deficits and all that sort of thing in that book. And I just think that, like now is kind of, you get the perfect kind of storm in that foreigners, because of the macro backdrop all over the world, and the US debt and all these other things are all kind of coming together, and that could lead to finally I call the Suez Canal moment. I don't know if people know what the Suez Canal was, but that was it was a crisis in 1956 where, long story short, Egypt nationalized the Suez Canal, which was owned by France and in England and Britain. They invaded. The U.S. gave a emergency bailout to England after World War II because they were bankrupt. Eisenhower got the UK prime minister on the phone, said, "Hey, if you do this, we're dumping all your bonds and your economy's done." And I think that at some point, foreigners are going to tell the U.S., if you continue to spend like this, especially when you're attacking us on the trade front, like, basically, we're not going to support your bond market anymore. And like I said, when you're this much in debt, your debt owners own you. You're not in charge. Yeah, yeah,
Yeah, yeah. I'm gonna you just hit on it here, but I'm gonna share my screen here. Okay. So here's the VIX that you were talking about, and a lot of the volatility that we recently had in the
yeah.
stock market. You can see it right here on the chart. And then also what you alluded to was the dollar. And so here's the DXY.
Yeah.
Let me make this a little bigger. I need to delete these little support lines here and stuff.
Yeah,
That
yeah,
stuff
they got broke.
that is past.
It's
But
pretty
here's
oversold and probably could bounce in here a few points. Go back to 102, 103. I think you
yeah.
probably agree with me on that. Like,
Yeah,
yeah,
yeah, yeah,
yeah,
yeah. We could get up, up in there. But
yeah,
what's interesting about this is with this sell-off in the dollar, usually what happens is you get people rotating into treasuries. So the benchmark for money over the past forever has
yeah.
been the U.S. 10-year Treasury, and we didn't get that. So we should have seen people moving into the U.S. 10-year Treasury, and they didn't.
Like, the
And
German 10-year treasury is like 2.4% now, and the Canadian is at 3%. So it's almost like the US treasuries have a premium in them. They don't have the discount anymore of being the reserve currency. Now, sometimes US treasuries had higher yields because US had higher growth rates. Like growth in Europe and Canada and places like this has been pretty sluggish over the last decade. So sometimes those higher growth rates mean your economy can handle the higher treasury rates. But the US economy is probably going to contract by 2 to 3% in the first quarter. So that's not the case. And they still have higher, yields in these other places.
yeah, yeah, yeah. Okay, I want to move on to one of your ideas. That the last time we talked was investment grade corporate debt, and so basically
Yeah.
what you're doing is so there's junk bonds, which are higher risk, so you get a higher yield, and then there's investment grade corporate bonds, which you get a lower yield, but they're considered a lot safer. So this bet is essentially like placing a bet that you think that these investment grade bonds aren't quite as good as everyone else thinks that they are, and so you put a put on that. And we had a moment where one of our listeners, Espran, now he did a short dated put on this. He did it for like, I think the expiration was beginning of May, and he's already taken profits. But he said, "Thanks for sharing the LQD put idea. I made a killing after the tariffs were first announced. Do you think that this trade has more upside?"
I would wait right now because I think when the market stabilizes, there's two ways the LQD will go down, which I'll talk about in a second. But I think the LQD it's bounced. It was oversold. He did right. He did the right thing selling it. I was thinking about entering it, re-entering it, but then I kind of just put on the brakes because again, VIX was 60 and everything was oversold. I'm like, I don't think I want to do it right now. But the LQD is rebounded from about 104 to 107. And what I think is there's two ways the LQD goes down. Number one, interest rates go up. So that means corporate, government interest rates go up. So then LQD kind of goes up in tandem with that. And if you go look at the way the LQD say sold off in 2018, that's what it did, is that they were raising rates all through 2018 or 2022. The LQD fell with it. But there's also 2020 and 2008 where government interest rates collapsed, but the LQD fell. I mean, corporate rates went up. Why? Corporations are badly affected by recessions. Credit tightens. It's tougher for them to borrow. They have less revenues, which makes that credit tougher to sustain. So in a bad economic downturn, those yields kind of blow out, even though government yields can go down. So now that I think we're in kind of a rally mode and I don't see downside in the bonds in the short term, I would wait, but I definitely think that this can go down. And I'm sure what this certain subscriber or this person found was that one thing I love about that LQD trade, even though it's not the most overly liquid option market, is there's no premium in those options. So you get that move, and that move was just 109 to 104. So it went down 5 points. Imagine it goes down 20 points. What you're going to get, you're going to get a gigantic return on just a 15-20% correction. So that's why I love that trade so much, is that, if you're buying puts on NVIDIA or one of these high flying stocks, the premiums are so high in those, you need a complete collapse in the stock to make 5-10 times on your money. Where with the LQD, you really don't need that.
Yeah. I put on a couple here for, now this one goes out till October. I didn't take profits, and now that I could see the future, I'm regretting that decision. But I'm kind of looking for one of these, like a COVID type sell-off. Do you think we could possibly have one of those coming? Or
if I'm correct in my thesis that maybe these tax cuts end up really hurting the bond market, I think that is when your trade could happen. And it'd be perfect timing because Bassett really recently said that they'll basically pass the tax cuts or whatever, have the bill ready, by about Memorial Day, then sometime in the summer pass it. So that's when you could see that rollover. So October could be the perfect time frame.
Okay. Well, we'll see. Time will tell.
And by the way, I plan on putting on that trade probably in a month or two. Yeah.
Okay. Yeah. I was up 600%, I think. And I was like, this is supposed to be an entire portfolio hedge, and that's not anywhere close to what I would need. I only got in 1/4% of my portfolio. My goal was 1%, and I just couldn't get it in. There was no volume, And
and the spreads are kind of large. You got and just this other advice for people: buy near the money, because sometimes I call them lottery puts. I like to buy some way out of the money puts and stuff. And on liquid stocks like Microsoft or Apple or something like that, you can do that, right? But on this, you really can't. You have to buy pretty close to the money.
Okay. Yeah, I went way down on the, or I guess way up on the risk side and way down on the price side. Okay, so you're a big fan of gold and gold miners for this cycle. You talk about specific companies in your book, Newmont, Franco-Nevada, and the ETFs like GDX, GDXJ.
Yeah.
But you also emphasize that they're trades, and these are not long-term holds. I call them, I don't know who I got this from, but I call them burning matches, where you don't know how long the wooden part of the match is. Go ahead and expand on that.
Well, it's just a crappy industry. It's like the costs are high and the margins are low, and if these companies make bad decisions, you get a little drop in the commodity price. Remember when I started out and I became bullish on gold at $300 an ounce 30 years ago, right? If you told me gold was $3,000 an ounce, I'd be like, these stocks we all be flying. And okay, they've rallied, but it's like the GDX and GDXJ are lower than the 2011 highs when gold was, just under 2,000 an ounce. So it's like I would have never expected that these stocks would do nothing for 20 years. And they took on a lot of debt and made a lot of bad decisions when things were good in the 2000s, and that hurt them. And like I said, there's all these geopolitical problems and mining problems. And so what I look at it is like, I think finally, though, we can re-enter a period like the 2000s when the HUI went from 40 to 600. We're now, because the companies are much leaner now, they learned from their mistakes last 10, 15 years, and they can be like a 3-5 year trade. But the fact of the matter is, in the long term, they have underperformed gold. And I think you just have to take profits at some point. And especially if you're doing junior miners like explorers, those are total burning matches. Like those things can go up. You get the right one 15, 20 times in value and then collapse right back down if the mine doesn't work out. And only like something like 0.1%, 1 in 1,000 mines goes into production. Another quote is Mark Twain used to say that a gold mine is just a hole in the ground with a liar on top, right? So that is what I would be very wary of. But I think we're still cheap. If you take like the GDX to GLD or like the HUI to gold ratios, they're very low levels historically. The gold to silver ratio or silver to gold silver is very cheap. I'm actually more interested in the silver miners right now because I think that silver is going to outperform. And I like stocks like Avino, ASM. And
here's the sorry, wrong
ASM's doing really well.
Gold to silver ratio right here.
Yeah.
So,
and if you go back even farther,
100, which is last
that's
time
the only other time it hit 100 was 2020. It's never hit 100 other than that. Yeah. And then silver went from 13 to like the mid 20s, went up 100%.
So you're bullish on silver miners. What was the one you mentioned? Avino,
ASM. So these are the kind of companies I like that are smaller caps.
Yeah.
That have new properties coming online, because that makes them like really, really leveraged to the price of gold. Like I was probably buying this thing right up $1. So, yeah.
Well, it's had a nice run since then.
Had a nice. I don't know if I'd be, but still, I think if you took a small position here, you'd be okay. I don't like the chase, but like I think this can go a lot higher if say, because let's say gold doubles from here, it goes to 6,000, right? Probably silver would be at 100 if that happens. So. Okay. Yeah. You're going to get much more leverage in those miners if that happens. And I remember the first company I ever talked about in your show just over a year ago was EXK, Endeavor. Yep. I still like that. So, and that's kind of lagged a little bit. So that's one you could probably comfortably buy here,
Yeah, I remember. Yeah, we talked about this one, and I saw
right at the bottom.
Thing.
Yeah,
just this sawtooth pattern that seems to repeat itself every 4 years.
Years, yeah.
And you were talking about it basically there. And I was looking at it. I was like, okay, I'm going to take a position when it gets down to here, which was basically $1. And it never quite got there. It got down to like $1.50 and then just rocketed. And
what I did is I almost nailed it at $1.50 because my theory was, okay, you know what I'll do? I'll buy some here. So I didn't get the full position I wanted. I'll buy half here at $1.50. And if it goes to $1, I'll buy the other half. Right.
Yeah.
And then my average price will be 125, and I'm pretty comfortable with that. Yeah. But it obviously bottomed there. And I think one reason I wanted to buy it there at around $1.50 was like, I was like, well, silver is, in the mid 20s or whatever it was then. And I'm like, well, like it's priced like silver is 15. So like, when it was at $1, silver was 13. So I think you had to take that. Like if you did again, the EXK silver ratio, you'll see that EXK was almost at an all-time low compared to silver when it was $1.50 at that price. Yeah. You'll see that right now.
Okay. There we go. And there it was.
It was even lower.
Basically a quadruple bottom right there. Just bam, bam, bam.
And by the way, this is the whole thing talking with my theory in my book, Maximum Pessimism. You can chase NVIDIA and all these tech stocks all you want, but you could have made a killing the last 15 years just waiting for Endeavor Silver to get to that ratio, selling it when it spikes, and then waiting again.
Yeah.
I don't think I would recommend someone putting their entire portfolio into Endeavor Silver, but if you had a good trading, like speculative money, you could just do that, and you can see it's still cheap compared to silver,
Yeah.
It's not expensive at all right now. So.
Yeah. Okay, got a listener question from CP. He's asking about possible opportunity for Aussie gold miners. Do you think they might be a safer option to U.S. and Canadian investors? He's asking basically about all the tariffs and tariff drama that's going on.
I think gold miners have been insulated because they actually don't have tariffs on gold and silver. Like they lifted that. So I guess maybe they consider money. I don't know why they did that. So, and there's a lot of gold that's being imported in the States. Like conspiracy theorists will say, because it's really not in Fort Knox and they're trying to replace it, you know? I don't know. I think when it comes to US, like it's still a stable jurisdiction for mining. Like Nevada is one of the best jurisdictions in the world, etc. So I'm not too worried about Aussie miners being any better than Canadian and US. The only thing I would warn you actually about Canadian and Aussie miners that are operating in the country is that if the US dollar continues this rollover, remember, one thing that Canadian miners and Aussie miners have going for them now is that they're getting tons of Australian dollars and Canadian dollars for gold at where their currencies are. But if like the Canadian dollar will go back to 80, 90 cents or the Australian dollar back to 70, 80 cents, you're going to get less dollars in that local currency. So remember that, because that will hurt the profits somewhat, you know? Okay. So, because I remember in the early 2000s when gold started to move higher, some of the best performing miners were the South African companies because the rands completely tanked. So they were getting, and even though the gold wasn't going up huge, it went from like 300 to 400 or 450 because the rand tanked. They were getting tons more rand, and all their expenses are in rand, right? For gold, that's one reason Russia never really collapses, because when that ruble declines, even if oil declines, their operating expenses and revenues are in rubles. So if the ruble goes down 50% and I don't know, like oil goes down 50%, well, in ruble terms, they're getting the same amount of dollars for oil, right? So
yeah, pay attention to exchange rates.
Yeah.
Okay, let's see. So we hit gold, we hit silver, we hit bonds, copper. What are your macro thoughts on copper?
Well, I think like if we are in kind of a stagflationary environment, like that's one reason copper's done well. But my issue with copper right now, and okay, if we look at like the copper to gold ratio, another ratio, it's very cheap by those metrics. And it's funny, in 2009, I don't know if you can go back that far if you want to show that ratio again on the charts.
Yep.
I did a conference here in the Bahamas, and at that point, copper was $1.40 or so.
Okay, here we go. This is gold divided by copper.
Yeah, if you can go way back to 2009, yeah. One second, let me go look at your, because I'm just looking at
2009.
Yeah. I actually said I wanted to melt down my copper. This is like, it's like, see that 200 there, that low ratio. I wanted to melt down my copper, or gold turned into copper. And I remember the gold bugs in the audience got really, really angry, right? and then copper really outperformed over the next 6 to 12 months.
Yeah.
And so this is gold. See, gold is, it's back to that high. So this is gold compared to copper.
Oh yeah, I could do the inverse here, but basically when you're up here, gold is expensive and copper is cheap, and when you're down here, copper is expensive and gold is cheap.
Yeah, so I said that at the time, and because we're kind of at the bottom of the economy as well. So the issue though I have with copper though, even though it is again cheap relatively compared to gold, is that it looks like we are going into some kind of slowdown or recession.
Yeah.
Who knows what that means for copper, like going forward. Now, the one thing with the tariffs, I don't think copper is immune from the tariffs. So that could help the price, because there could be less copper and kind of supply restraints coming into the US, and to kind of like build out copper mines and replace that production domestically, that's going to take years. Like that's not something that's going to happen in 3 to 6 months. Yeah. Right. It's like the thing about an oil well is easy to drill. You put the thing in there, and if you hit it, like you build your wells, and in 3-6 months you're pumping out oil. But copper mines, gold mines, you have environmental regulations, you have red tape, you have just the infrastructure you have to build. It takes years to put these things into production. Like there's that thing, Northern Dynasty, which is up in Alaska, which has been in the works for 20 years. Even if that thing is put into production, it's a huge copper deposit. But they've had a lot of environmental concerns about it. That thing is in the middle of nowhere, and it's going to take 3 to 5 years to put into production. NDM, if you want to look at it, is the ticker. A lot of people are buying that, thinking the Trump administration is going to, basically allow it to go into production. I'm not recommending this one at all. I actually bought it back in 2003 when I first started out, when it had that spike to $10.
Looks like a basing pattern right here for years.
Yeah, it does look good, but the problem again with junior mining, talk about burning matches, this thing has 20 times the amount of shares outstanding as it did.
Wow. Okay.
Yeah. So you have to take that with a grain of salt. I think the
Average shares outstanding. Okay. Oh, this is just quarterly. If I go to
this
annual.
quarterly, but if you
Okay.
go annual, go back 10, 20 years, you'll see,
Yeah, you can see it just never gets smaller.
Yeah,
Okay.
that's the problem with junior mining is that you have to, you know, there ain't no stock buybacks going on in junior
No.
mining. You know?
Yeah, they don't have exactly a, dividend program here.
Yeah. So, like if you really wanted it, that's a gambling stock to me. Yeah, okay, they can get that thing in production, even if it takes a while. Maybe the stock could go to $3 to $5 in anticipation, but I'm just telling you, like I have been in that industry for over 20 years. That thing would take. And here's another note, just on that stock in particular, because I've had some people try to pitch it to me, is when that stock got its last rejection, or one of its last rejections, it was actually November 2020 by the Army Corps of Engineers under the Trump administration, saying that this thing's not going to work. So that thing isn't necessarily. And look, man, I'm a mining guy, but if you go look if you look at a picture of where it is, it's this really picturesque area. There's a big tourism industry there for fishing and hiking and all this sort of thing. And it's like, you do have to take these things. Like if you go look where the oil sands are in Canada, that's the ugliest area you ever seen in your life. Who cares? Just drill it, right?
Yeah, it's like the Permian Basin. Nobody
Like
cares.
Permian, yeah, nobody cares. Yeah, but like when you're in these kind of picturesque areas, I think it becomes a little more complicated,
Yeah,
So
yeah,
yeah,
yeah.
yeah,
Okay. Yeah, there's a pile of gold at the bottom of the Grand Canyon, but we'll never see it.
So
Okay. All righty. Copper. So that's interesting. So you think that gold's expensive right now and copper's cheap on a comparative basis, and the charts look exactly like that.
yeah, I think that copper you're still okay and the stocks aren't overly expensive, but I'm just worried about the economy,
Yeah.
right? That's my issue. And like there are some good copper, like Southern Copper is a great company, right? SCCO. I don't own any of it, but that is a fantastic company. They're based in the States or Canada, but their production's in Peru. That's a great company. But the issue is, like I said, like you get an economic slowdown, it's just, that's kind of the issue. But I guess the issue also could be supply right now because copper is not immune to tariffs. And most of the copper in the world is produced in places like China or Chile, in places like that, Peru, places like that,
Yeah. Okay. Okay. And platinum and palladium. He's also asking about platinum and palladium. The one I really see with that is the ratio, like we just pulled up with gold and silver. What are your thoughts on platinum and palladium?
I like platinum. It's like it's just sitting there. It's just doing nothing right now. And another thing too is like I don't know what your thoughts are on this, but I do think the kind of whole green like car thing, EV thing, because platinum palladium are using catalytic converters,
Yeah.
right? And with that kind of like going the wayside in the Trump administration, I think that really helps platinum and palladium because you're gonna see, more gasoline fueled cars, et cetera, like and like the biggest electric car makers in China right now, US has 100% tariffs on them even before the tariff thing took off. So I kind of like them. Like I like bases. I'm a big believer as the longer the base, the more the space, which means the bigger the breakout.
Yeah.
And you go look at like platinum there back in the 90s before that huge breakout. It's kind of similar, but you don't know
Yeah.
how long it's going to go on for. It could go on. This is again kind of buying pessimism. Like it might be a boring trade for another 6 months, 12 months, 18 months, but your probably downside's kind of limited right here.
Yeah, yeah. Like
Yeah.
this basing pattern. So this is the monthly chart. So every bar is a month. This
Yeah, that
started
took 8 years,
91 to 99. Yeah, 8 years before you finally had
Yeah.
if you just bought those bottoms, but I mean, this stuff isn't free to store,
Yeah.
Um,
Well, you
they're not
you could
storing this stuff
buy
for you
some of
for
the
free.
you could buy some of the companies and maybe they pay a dividend and you can kind of sit there and wait. But the good thing is, look, you're basically gone nowhere since 2015.
Yeah,
So you're getting 10 years now into this. So, maybe it will finally move, and I bought in stocks like that where maybe they're basing for years and then you finally see a I think the thing is about buying cheap assets, you have to find the catalyst, like, and like I said, maybe this kind of move away from EVs because a lot of those subsidies and stuff are going to go under Trump. Maybe that's kind of the catalyst for platinum and palladium. So
yeah.
yeah.
Okay. Um, All right, oil and gas. Here is the WTI chart. We were basically putting in a base. I'll bring up the weekly here so we get a little bit better time frame. I had this white line drawn at $67 for like ever, and then we finally broke below it. Touchdown. I think I got it on the low there,
Yeah.
55.12. What do you see right now for oil?
Well, that was a bad breakdown, and I don't know if we go to a global recession, actually, even I mentioned this in my book, as I mentioned that if because my book is all really pro commodities, saying at some point when we get a bad breakdown, they're going to have to respond by printing money, buying bonds, doing QE again, to support that debt market, which is a bubble, and that will cause commodities inflation to go up. But one thing I mentioned in my book is that, look, if we get a recession, oil could go back into the 40s. So I would wait on oil here. It's like, I know we did get oversold. It could continue to bounce here if there, and I think we are in a market rally short term, but I would just wait because that was a bad breakdown. And like I said, like you go look at that, you're taking a look at that 2020. I know 2020 went to negative for a while in the futures, but if you go look at even 2008 or 2015, like you could be $30-$40 on oil in a recession,
Yeah,
So,
yeah, pretty gnarly sell off here.
and what's actually, this is killed too. The whole drill baby drill thing is basically done now because you're talking about the Permian Basin or whatever,
Mhm.
Permian, like that is like you can't make money at these oil prices in those areas. So yeah, you don't need huge oil prices, but you need 70, 80, you know.
Yeah, one thing you say in your book is you say, I'm not going to recommend stocks like Exxon or Chevron. The problem with these integrated multinationals as pure oil and gas plays is they
Yeah.
tend to be more service plays, as on top of production, they resell oil and gas at the consumer level along with food and other goods at their chains and gas stations. These companies have more a correlation with the stock market and economy than they do with oil and gas.
Yeah, and go look at the Exxon chart, like when the market fell apart in early April,
Hmm.
um, after quote unquote Liberation Day. Um,
Oh,
uh,
right here. Yes.
yeah. It tanks with the stock market.
It did. Yeah, I
And
mean, it
if
was
you
up
go
here and
look at
went
it,
boom.
like you look at it, I'm getting a 20-year chart myself.
Hmm.
Like same thing, it did tank in 2020, but the stock market tanked in early 2022 when oil went negative.
Yeah.
So and Exxon kind of went sideways all through the 2010s, and oil went from before that tank in 2020. And the thing is, it's because again, I think that correlation with the stock market. So I rather buy like Halliburton or Schlumberger or like the pure drillers if you're going to look for a pure oil play. You
Okay.
know,
Okay. Drillers, pipelines, like that.
because again,
Okay.
if you get a super long-term chart of Exxon, which you have up now, it's like even go longer. Yeah, get a 20-year. Yeah, look at that's basically correlated with the stock market. That's not correlated with oil. You
That's
know,
a really, really, really good point.
yeah.
Yeah.
So
Yeah, that kind of looks like the S&P 500 right now more than it does a cheap commodity.
exactly. But if you go look at Schlumberger or Halliburton right now, they're close to like multi-year lows. Because oil is. Outside of the really tank during COVID, like I'm
Yeah.
looking at Halliburton now, it's like 15-year low.
Yeah.
So you
Yeah.
know,
Here's Schlumberger.
yeah.
Okay.
Yeah. Again, you take that kind of COVID drop in 2020 away, it's like, you're talking multi-decade lows.
Yeah.
So
Yeah. You're right. Okay. All right, good to know. Okay, you also mentioned other commodities that you think will do well, like agricultural ones. Start thinking about that. Now, I've pulled up the charts on these. I've never bought them, but you really got me thinking about it. Things like wheat, sugar. Tell us about that.
yeah, so with those kind of commodities, they're trades to me. And again, they're like really patient trades. It's not something you have to be in all the time or the whatnot. And if you go look at the history of those, I'm putting on a wheat chart myself just to look at it, just to kind of jog my memory. Like you look at wheat, like over the last, again, 15 years or so, when it gets down to about 450, $5 a bushel, usually it bottoms and then it will rally to $10 a bushel. It did that in 2008. It did that in 2012. It did that in 2022. And then corn would be the same way. And so what you want to do is just wait for those to get cheap. And of course, you could buy call options on the ETF, so you could buy futures. Of course, futures you'd have to kind of roll out and really know what you're doing. So I don't recommend that for the average investor. But again, you look at the last 20 years in corn, you get to about $3, $3.50 a bushel. Then it usually rallies to about $7.50 to $8. So it's a double. So I don't think anyone can complain about doubling their money in a 2-3 year period. So with those, they're really trade oriented. Wait till they're cheap and then sell into the spikes. And actually, if you're a short seller, you could short the spikes as well and then make maybe a quick 30, 40, 50% when they spike, because they tend to be extremely spiky trades that go up and down. And because of technological advances in farming, etc., the cost of production continues to go down. Like if you adjust these corn and wheat prices, maybe they're higher than they were 20 years ago, but for inflation from 40, 50 years ago, we're still paying a lot less money for wheat and corn.
Yeah.
Yeah.
Okay. So this is corn futures right here. So you're saying kind of like the 450, which is basically where we're
Yeah.
at now.
And look, you're going to have these ranges. You can see in the 70s, the range got higher. And then in the 2000s, the range got higher. So the ranges are going to be higher because of inflation.
Yeah.
But once you hit, and at some point, 10 or 20 years from now, you'll probably have another higher range, right? But I just think selling into those spikes and buying those kind of like basing patterns is kind of the way to go in those.
Yeah. There's a corn ETF, right?
There's corn and wheat ETF, I think.
Yeah. And there's a sugar ETF. What
The
do
sugar
you think
ETF.
about sugar, coffee?
Let me go look. Sugar is probably a good trade right now. It's getting right to the low end of its recent base, around 18 cents. Now, the real low in sugar tends to happen around, under 10, but I don't think we're going to hit that again. So I think this is a pretty good trade right now. Coffee's had a big spike, so I stay away from that.
Okay.
Coffee's gone from like $1.50 to over $4.
I should probably spell sugar
I
right.
think
So maybe
there's been some shortages in coffee in Africa due to weather issues, and that's what caused that spike. Because the Arabia coffee, which is like the best stuff, like there's been like a shortage in the crop there.
Yeah. I remember that when I totally misplayed that one. That could have been a moneymaker. Okay, agricultural. Emerging markets, India and China. What possibilities do you see with emerging markets?
Well, I love India longer term. I like the IFN. That's my favorite way to play it. It pays a nice dividend. I think India is basically where the United States and the UK was in the 19th century. They're going through their industrial revolution. They're going through their biggest growth part of their economy. Their demographics are very positive. They have a young population. So I think India is something where I don't think you want to chase it, but on these declines, like what happened recently, you buy the dips. And sometimes you can get these very vicious dips like in the early 2000s or 2008 that are 60, 70%. And you always buy it and you're going to have big dividends. And you can buy this. Like if you want something for your kids' retirement, I wouldn't buy the S&P. I would buy this because India is going to have higher growth rates. And one thing that people have to understand about India and China, this whole thing that happened during colonialism, in the 16th, 17th, 18th century, where the West grew, like Western Europe, United States, Canada, UK, UK and US were the two big superpowers. And we took growth away from India and China. That was an anomaly in terms of global history. India and China are usually about 40% of the global economy. And China's back to around 20% now. And India is about 4%. And my opinions are going back to that. So that's the thing you have to understand is that was like a few hundred years of anomaly of history. Like if you go look at pre-colonialism, like the two biggest economies in the world are India and China, right? So so that's kind of what's in, population has a lot to do with that. So that's something. Now China is a little more difficult because obviously they're the epicenter of the trade war. And one thing that India has going for it is because it was a British colony, it has Commonwealth law, even though India has a lot of corruption, it still has Commonwealth law and like proper accounting standards. And China, you can't believe anything these companies. They have two different standards for what they report in China, what they report in the States. A guy named Carson Block, who had Muddy Waters, who did a lot of short selling, he exposed a lot of these frauds like 10, 15 years ago. And anyhow, Carson, he talked about a lot of that stuff. But so it's really difficult. And then of course the whole tariff thing, etc. So, but the thing you do have positive on the Chinese side is the valuations are very cheap.
Here's the China ETF.
Yeah, yeah, it hasn't really done anything for years. When it was down there, like when you see that 2024 low, like
Yeah.
if you could put up the Hang Seng, like the Hong Kong market went back to where it was in 1997, like before they went from UK back to China. So it was at like a 27-year low. So one thing that China has going forward is that the valuations are very cheap. Then there's a moralistic thing. Do you want to invest in China because you think, certain things they do in trade or shady, etc. So that's always something you have to look at. So, but yeah, I'm more positive on India going forward on those dips. But I do think there is a place, for Chinese equities, etc. Just because they are so cheap. And by the way,
Okay.
the reason that India fund looks like that is they disperse assets in term of stock profits from the profits from their portfolio every quarter. So actually, if you adjust, I don't know if you can do this, but stockcharts.com allows you to do this.
Oh,
If
just for dividends?
if you adjust for the
Yeah. Oh,
dividend,
wow. That's a totally different
it's a
chart.
totally different chart. Yeah. It's like it
Oh,
actually
Jesus. Okay.
yeah, over the last 20 years or 25 years, it's outperformed the S&P adjusted for dividends. Yeah, so
Oh, this is why you're saying buy and hold for your
yeah,
kids.
yeah.
Wow. Yeah. Okay. So this is without dividends. It just
Yeah,
looks
yeah,
like
yeah.
terrible or just sideways. That is adjusted for dividends. Okay.
Yeah. And I think
Wow.
you have to
What the
adjust it
heck
for
is their
dividends.
yield?
Well, again, because they take a percentage of their profits on like the quarterly gains in the portfolio. If
Yeah.
the Indian market booms, they can have years where they're paying 15-20%. Yeah.
Oh, wow. Okay.
Yeah.
I'm going to have to look
Obviously,
into
when
this
the
more.
market tanks, it'll be a couple percent. It's nowhere near as much, but but like I was telling people when this went to 19, it's like look for the 14, 15. I would like it to go to 10,
Yeah.
but that would be a big bear market in global equities
Yeah.
for it to, you know. So, but what's interesting about all this stuff is going from Europe to China to India. If you just take it from the beginning of the year,
Yeah.
everything is outperforming the United States. So it's very interesting that now, granted, the United States have been outperforming everything else for years or even a decade, and the U.S. market was much more overvalued. But that's what's kind of interesting about that whole trade is that everything is now outperforming the United States.
Yeah. Yeah. Okay. I like it. All right. Rare earths. You talk about lithium, cobalt. Go ahead and pontificate on that for a bit.
Well, lithium is interesting now because China is restricting rare earths,
Yeah.
to the United States. So what makes it kind of interesting is, lithium did get a bit of a bounce, the last few weeks, and I think that's obviously the market's bounced too. But I do think you're going to see like a lot more mining for this. Like in Canada, they have a thing called the Ring of Fire up in Ontario in Canada, and the Ring of Fire is full of lithium and rhodium and all these things, but because of Trudeau being prime minister, and he's kind of anti-mining because he's a green guy. They haven't really explored it, but now with kind of these tariffs and China not really exporting, I think there's going to be an incentive to really exploit that. So, but I've never been a big lithium person, and there's two reasons for this. Number one, the actual lithium price went parabolic after
Yeah.
COVID when all these green energy things went crazy in 2020 and 2021.
There you
And
go.
number
There's
two,
lithium.
I have something called like the CDNX or Vancouver indicator. Yeah, when parabolic, that's
Yeah.
a total. Like it ain't going back to 85 anytime soon.
Yeah.
You know? And then I have something called the Vancouver indicator. Is that I'm from Canada and I've dealt with a lot of these guys out there for a while, these mining promoters. When they start getting into a hot sector like that, right? I become like very wary because usually like they did this in 2006 in uranium and 1999 in tech. People were moving from gold and silver miners, like juniors, into making them in tech in 99, making them into uranium in 2006. Everyone was turning their companies into lithium companies, in 2021, 2022. And I was like, well, okay, that's the top. And it
Yeah.
was.
Red flag. Red
Red
flag.
flag. So I don't know, like, can you really make a lot of money down here at these prices? And I think the EVs are kind of a scam and going to be a bit of a bust longer term. Like there's so many issues with them. And the batteries and they don't work in the cold. And I know they say they're getting faster chargers and all this stuff, but I don't know. And if let's face it, if oil prices go down to 40s in a recession, there's no incentive to buy an EV.
Yeah, yeah.
Yeah.
I
So
literally toured a Volkswagen, the kind of a think tank shop where they're designing the new cars and all that. And this was a few days ago. And I was talking to a lot of employees there, and all of them had an electric car and then went back to an ICE engine. I'm like, these are the guys that are designing it.
yeah. Well, I watch this guy called just be a little lighter note called the McMaster. He's this British guy. Goes he does food reviews, mostly of fish and chips, but he's got a Porsche EV, and anyhow, all he does is bitch about this thing like 24/7 in terms of having to recharge it and all the problems with it, and the resale value is collapsed. And those Porsche EVs, by the way, are better than Teslas. Like they're better cars than Teslas. So I can't. And I don't know if you've seen like the Tesla resale value. Like it's like completely tanked. Like the
Okay,
Tesla you
no, I
bought for
haven't.
60 grand 3 years ago, you can sell for like 25 or 30 now. It's yeah, and I know all cars lose value, but they're probably losing value 2 or 3 times as much. So
I asked them about how long the batteries last and, what does it cost to replace them? And they all kind of looked around the room and smiled and they said, just buy a new car. I'm like, wow,
yeah,
that's your solution.
yeah,
Okay.
like
Okay.
yeah, it's like if your battery burns out on your cell phone, right? Yeah,
Yeah.
you just buy a new cell phone.
Yeah.
You
Yeah.
know?
Yeah. Or
You
your
know?
toothbrush or whatever.
Yeah. So
Okay. Quick on Cobalt. I brought up Cobalt a while ago on this show, and we were trying to figure out a way to play it. And anyways, here's the Cobalt chart. So I get kind of interested when we get at the bottom part of the chart here. And what I found was that Glencore was the biggest cobalt producer. They produce something like 1 out of 4 tons of cobalt that comes out every year, but it's only about 4% of their overall revenue for the whole company. Have you found
but
any cobalt plays? Go ahead and tell us about
Glencore,
cobalt.
Glencore has gotten pretty cheap. So that's a stock I would look at right now. It's gone from $6 to about 350. So I think I would look at Glencore right now.
Yeah.
It's
Okay.
about a 3.5% dividend.
Yeah.
So yeah, I think Glencore is definitely a company, and Glencore is kind of one of these. We talk about this now. If you go look at the longer term chart, it may have to fall more to get to those 2016 or 2020 levels, but
Yeah.
I think you can never get the exact bottom. So one thing I talk about in the book too is, you can put your toe in the water. You could buy maybe a third or quarter of the position you want to buy in Glencore right now. And if it did get, back to that $3 level, right there, you're talking about, you could buy more there. But you can see it's come off pretty good.
Yeah.
While
Yeah. It's
the
come way
stock is down
down. Yeah.
yeah. So I think that's definitely something I would look at. So
Okay. Okay. Yeah, I doubled my position. I thought it was decent up here, and then just recently it just completely s the bed. And anyways, I doubled up. But yeah, you think you could even see more downside going into a recession?
I think like again that would be my target, that 3 to 4 area, 280 to whatever.
Okay.
But yeah, I think if you bought some here, because it's pretty oversold, like at the very least you could probably buy as a trade and buy it here and then sell it at 9.
Yeah. Yeah.
So
Okay.
uh,
All right. Cool. Awesome. Well, thank you very much, David. I will put a link to your book in the pinned comment below and in the show notes below. If viewers want to get a hold of you and follow your work, how can they do so?
yeah, so I've rebranded. I used to run Addicted to Profits. Now it's called profitfrompessimism.com. And I have like 2 tiers or I have a bunch of tiers, but the 2 basic tiers are like I have a little $5 Patreon, which is just a weekly like video update. And then I have a more in-depth tier, which is $27 a month. That like you You get updates. I have a little trading vlog. I have a little $5,000 and a $30,000 portfolio because what I want to show is like average people can kind of do what I'm doing. So, and we update that on a weekly basis as well. And you know, I do these videos and I talk about. I have other stocks that I like. Like I actually just bought 2 stocks this morning, kind of 2 more beaten up plays because I do think like we're heading into this rally for the next little bit. So yeah, and if you're interested, like I said, $5 a month is what? Don't go to Starbucks one day and you'll be good. I think a
Right on.
Starbucks coffee costs like $5 now. So
Yeah, it does. It does.
yeah, so
Right on. Okay, well, thank you very
okay.
much, David. We'll put all your links down below.
Yeah.
And yeah, we'll have to do this again in a couple of months.
Okay, take care. Yeah.
All righty. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.